Chapter 1: The Seeds of Speculation, Tulip Mania of the 1630s. Chapter 1: The Seeds of Speculation, Tulip Mania of the 1630s. Tulip bulbs. To many, they represent beauty, vibrant gardens, and the profound artistry of nature. However, in the early 17th century in the Netherlands, they became something altogether different, a symbol of greed, folly, and the explosive rise of speculative bubbles. In this chapter, we will embark on a journey back to the 1630s to explore the fascinating phenomenon of tulip mania, examining its origins, its effects on the Dutch economy, and the invaluable lessons it offers to contemporary investors. The historical context. A prosperous age. The 17th century was a golden era for the Dutch Republic. Following a successful struggle for independence from Spain, the Netherlands emerged as a major commercial power in Europe. Innovation, trade, and a burgeoning middle class fueled economic growth. As wealth began to spread, the appetite for luxury goods soared, and none captured the imagination and the greed of the population quite like the tulip. The allure of the tulip. Tulips were not just beautiful flowers. They were exotic imports from the Ottoman Empire, arriving in Europe in the late 1500s. Their vibrant colors and unique shapes made them incredibly desirable. Their rarity and beauty commanded high prices, particularly for certain favored varieties. But what began as a luxurious indulgence quickly transformed into a speculative frenzy. The tulip market takes off. Investors were drawn into the tulip market for many reasons, including social status. Owning rare tulips became a status symbol among the upper classes. Speculative gains. The potential for massive returns attracted risk takers. Some bulbs appreciated in value by as much as 1,000% within a single season. Financial instruments. The development of contracts that allowed buyers to purchase bulbs that would be delivered in the future fueled speculation, creating an illusion of safety in this unreal market. The bulb's price explosion. At the peak of tulip mania in 1637, a single bulb of the extremely rare Semper Augustus was reportedly worth more than 10 times the annual income of a skilled craftsman. Imagine that. This absurd valuation was underpinned by nothing more than the emotions and whims of investors taken by a collective frenzy. The psychology of a bubble. Bubbles are fueled by market psychology, and tulip mania provides a textbook case of how irrational behavior can dominate financial markets. Key psychological factors included herd mentality. As prices skyrocketed, more individuals wanted to join the fray, convinced they could secure wealth without consideration of the underlying value. Fear of missing out, FOMO. With tales of enormous profits circulating, investors feared being left behind, driving more buyers into the market. Overconfidence. Many investors believed they understood the market and could outsmart others, leading to reckless decision-making. Lessons on market psychology. Understanding the psychology behind tulip mania can lend insight into our own investing behaviors today. Be wary of herd mentality. Never follow the crowd blindly. Instead, conduct independent research and analysis before making investment decisions. Screen against FOMO. Fear of missing out can lead to impulsive investments. Take a step back, assess the situation, and ensure your decisions align with your overall financial strategy. Humility in investing. Recognize that the market's emotions can often override rationality. Overconfidence can lead to disastrous losses. The collapse, a sudden awakening. In February 1637, the tulip market's bubble burst. Buyers who had been eagerly snapping up bulbs suddenly grew hesitant. As prices began to plummet, panic ensued. Investors tried to sell their tulip bulbs, but the previously insatiable demand vanished within days. The aftermath. By the end of tulip mania, many speculators faced financial ruin. Market collapse shattered fortunes, with some individuals losing everything, including their life savings. The event left an indelible mark on the Dutch economy, as many learned firsthand the consequences of unbridled speculation. Present-day parallels. The lessons of tulip mania resonate today, presenting actionable insights for modern investors. While the financial landscape may have evolved, the susceptibility to speculative bubbles remains a core feature of human behavior. Recognizing modern speculative bubbles. Today's market is not immune to the same forces that precipitated tulip mania. Consider cryptocurrencies. The explosive rise of assets like Bitcoin and Dogecoin in recent years can exhibit similar traits as tulip bulbs driven by speculation. Stock market trends. Certain tech stocks have experienced valuations based on hype rather than fundamentals. The Dogecoin craze even saw it emerge as a contender against established cryptocurrencies without a sound business model behind it. Applying the lessons to survive and thrive in financial markets today, consider the following practical strategies. Diversification. Just as the tulip market concentrated wealth in a single asset, today's investors must diversify their portfolios across various asset classes to mitigate risk. Focus on fundamentals. Investigate the underlying value of your investments. Ask yourself if the asset is backed by tangible worth or simply speculative hype. Regular reassessment. Market conditions fluctuate. Regularly review your investments to ensure they align with your risk tolerance and financial goals. Quiz. Assessing your investment approach. When considering an investment, how often do you research its fundamentals? A. Always. B. Sometimes. C. Rarely do you find yourself buying assets just because others are investing in them. A. Never. B. Occasionally. C. Frequently. How diversified is your investment portfolio? A. Highly diversified. B. Moderately diversified. C. Not diversified at all. After completing this quiz, reflect on your answers. Are there areas for improvement in your investment strategy? Summary and key takeaways. Tulip Mania serves as a stark reminder of the fragile nature of market sentiment and the importance of informed investing. By understanding the psychology of bubbles and studying historical events like Tulip Mania, investors can develop a more resilient approach to their financial strategies. Key takeaways. Market psychology matters. Awareness of factors such as herd mentality and FOMO is crucial when making financial decisions. Think long-term. Avoid speculative investments that lack fundamentals. Focus instead on long-term growth strategies. Diversify. Maintain a well-diversified portfolio to shield yourself from the risks of concentrated investments. As we turn the pages of history, let's carry forward the lessons learned from this flower frenzy and apply them to our financial futures. The journey toward financial empowerment requires both knowledge of the past and a commitment to responsible investing principles. In the next chapter, we will transition to the turbulent waters of the South Sea bubble, uncovering another critical yet often overlooked episode in financial history. Chapter 2, The Rise and Fall, the South Sea Bubble. Chapter 2, The Rise and Fall, the South Sea Bubble. The South Sea Company is a fine thing, Mr. Archibald Peterson mused as he casually strolled through the bustling streets of London in late 1719. Young, ambitious, and caught in the exhilarating current of economic opportunity, Archibald saw the world transform before his very eyes. A mere trader from the East End, he was on the verge of becoming a man of fortune, if he only capitalized on the South Sea Company, which had taken the capital of England by storm. A historical context. The South Sea Company's rise. To understand Archibald's fervor, we must step back and discuss the South Sea Company, established in 1711 to exploit the lucrative trade potential in South America. Initially aimed to manage the national debt, the company promised enormous returns through a monopoly on trade in the South Sea, particularly in territories that were elusive for most English traders. The allure of speculation. By 1719, the shares of the South Sea Company were on a relentless upward trajectory, driven both by speculative zeal and a burgeoning desire among the populace for wealth. What fueled this fervor? Government support. The British government sanctioned the company, intertwining its credibility with state financial interests. Public narratives, jingoistic tales filled newspapers about untapped riches waiting to be plundered in distant lands, enticing even the most skeptical investors. Cultural shift. The early 18th century saw a shift in attitudes toward wealth, trade, and speculation. For many, joining in the excitement of stock trading was a route to social mobility. Much like the allure of modern technology stocks, Archibald felt invincible. He believed that a little doubt could mean he was not keeping up with his peers. Archibald, the fictitious investor. Our protagonist, Archibald, stands as a representation of countless others who would soon become enmeshed in the web of financial hysteria. Early investment decisions. In 1719, after hearing fervent discussions at local coffee shops, where the elite mingled with society's lower tiers over cups of steaming beverages, Archibald decided it was time to invest. He had saved £300, a considerable sum for a man of his stature, and as the price of South Sea stock raced past the £100 mark, Archibald felt an electric excitement. Decisions made, peer influence. He overheard others, guaranteeing swift profits, convincing him to invest hastily without proper research. Inaction, fear. A fear of missing out drove him to divest his modest savings, believing in the infallibility of the trend. The impact of leverage. Archibald was not merely content with buying shares. He also ventured into borrowing money, believing that leveraging his investments would multiply his returns. Using credit. Archibald borrows an additional £200 from a local moneylender. Risk stretching. With £500 now in play, the stakes were high. His potential winnings could yield life-changing wealth, but he danced dangerously close to financial implosion. The dangers of following trends. As Archibald watched the share prices climb, he became an ardent believer in the wisdom of crowds, a theme that echoes through financial history and persists today. Herd mentality. The disappointing truth remains. Archibald did not understand the company's fundamentals. His investment was largely predicated on rumors and mob behavior. Psychological manipulation. Media and pundits fueled enthusiasm, convincing the masses that wealth was ripe for the picking. Cascading decisions. The more stock prices soared, the more others felt compelled to join in, creating an unsustainable bubble. This phenomenon remains relevant today. Modern investors often jump onto trending stocks or cryptocurrencies due to social media hype, fail to conduct fundamental analysis, merely trusting everyone knows what the best investments are. The inevitable collapse of the South Sea bubble. By the spring of 1720, the South Sea Company's share prices reached an astonishing peak of £1,000. Yet, it was an illusion, and the facade was beginning to crumble. Signs of trouble. Archibald, now fixated on market trends, noticed the first cracks, dwindling enthusiasm. Some early investors, having made a tidy profit, slowly started selling off shares. Negative media coverage. As news of overextended speculation spread, the public's confidence began to crumble. Archibald, seeking to remain oblivious to these troubling signals, doubled down, convinced that his investment would soon skyrocket again. The crash. In September 1720, panic swept through the streets of London as the South Sea bubble burst. Share prices plummeted, and soon Archibald found himself one of its many victims. Burdened by crippling debt and witnessing the collapse of his dreams, he was forced to adapt. Lessons learned. Connecting the past to present. Archibald's story serves as a poignant reminder of fundamental investment principles that remain relevant in today's financial landscape. Key lessons from the South Sea bubble. Do your research. Avoid investing solely based on trends and peer pressure. Always conduct fundamental analysis of any investment. Be wary of herd mentality. Just as Archibald succumbed to the collective excitement, so too can modern investors. Recognize when collective behavior is clouding judgment. Risk assessment. Understand your risk tolerance, especially when employing leverage. Avoid high-risk situations, particularly when emotions overrule rational decision-making. Diversification is key. Do not put all your eggs in one basket. Spreading investments across different asset classes can mitigate risks tied to single investments. Practical exercises. Your financial time machine. To further solidify these lessons, here are some interactive components to contemplate. Investing reflection quiz. What factors influence your investment decisions? Have you ever followed a trend without research? What was the outcome? Scenario analysis. Imagine you have $1,000 to invest. Research a trendy stock and a fundamentally strong company. Which do you choose and why? Create a diversified portfolio based on your analysis, selecting stocks from different sectors such as technology, healthcare, and consumer goods. Discussion forum. Engage with peers or online investors about the dangers of market bubbles. What examples resonate most, and how does fear of missing out, FOMO, influence you? Key takeaways. As we traverse through history, Archibald's unfortunate tale resonates with many who, even today, experience the highs and lows of investing. The South Sea bubble exemplifies the dangers of speculative investing without due diligence. Proper risk assessment and a commitment to research can provide insight into making sound financial decisions. Interconnecting historical financial mistakes with present day investing creates a foundation for more informed financial choices. With these lessons in mind, let us embark on our next journey, one that centers around a monumental event that shaped modern economic thought, the Great Depression. Prepare for the insights that lie ahead as we explore resilience in the face of financial adversity. Chapter 3: The Birth of Modern Economics, the Great Depression. Chapter 3: The Birth of Modern Economics, the Great Depression. As the world teetered at the brink of economic chaos in the late 1920s, few could have anticipated the catastrophic effects that lay ahead. Enter Jacob Burrows, our guide through these turbulent times, a wise banker whose insights would illuminate the path for future generations. Join us as we delve into the Great Depression, a period marked by severe economic downturn, and explore the invaluable lessons it offers for modern investors. The rise of Wall Street, setting the stage. The Roaring Twenties, a decade characterized by unprecedented economic growth and a speculative frenzy in the stock market. Investors bought stocks on margin, believing that the good times would never end. Jacob, watching this surge from his bank's soaring oak desk, felt the palpable excitement in the air. But as he sipped his coffee, he remained cautious, a belief that, as the saying goes, what goes up must come down. The crash of 1929. On October 29, 1929, known as Black Tuesday, the speculative bubble burst. The stock market, which had skyrocketed over the previous few years, plummeted suddenly, wiping out billions of dollars in wealth. Jacob observed the chaos unfold. Panic-stricken investors rushed to sell as stock prices tumbled, creating a cascade of failures. Jacob's wisdom was rooted in diversification, one of his core tenets as a banker. Avoid putting all your eggs in one basket. Jacob had advised his clients to build a diversified portfolio, balancing stocks with bonds, commodities, and cash. Many heeded his call, but many more remained heavily invested in a single asset class, the stock market. The lesson here is clear. Diversification protects investors from the risk of sudden market downturns. The depths of despair. The aftermath of the crash was harrowing. Unemployment soared, businesses failed, and whole families lost their homes. Jacob recalls a haunting image: long lines of anxious citizens waiting for bread, their eyes hollow with despair. The banks, once colossal institutions of stability, began to fail. Depositors rushed to withdraw their savings, but many banks lacked sufficient cash reserves to meet these demands. The importance of cash reserves. Jacob understood the significance of having a financial cushion during hard times. He had always advised his clients to set aside a portion of their investments into cash reserves. Key points on cash management: maintain liquidity. Have readily accessible cash to cover your expenses, especially during emergencies. Plan for unexpected downturns. Create a financial buffer to weather storms, just as Jacob did with his own savings. Evaluate your burn rate. Know how long your savings can sustain you in case of job loss or market downturns. The Great Depression ultimately highlighted how a lack of cash reserves could compound financial distress. Jacob often reflected, an optimal portfolio is not just about maximizing returns, it's also about preparing for the unexpected. Navigating the storm. As the years ticked by in the early 1930s, Jacob began to implement lessons learned from the crisis. He transitioned his banking strategies to guide his clients more effectively through the tumultuous economic landscape. Risk management strategies. Jacob introduced new risk management techniques, emphasizing a combination of the following strategies. Asset allocation. Encourage clients to balance risk and reward by investing across different asset classes. A mix of stocks, bonds, and safe haven assets like gold can provide stabilizing benefits. Rebalance regularly. Jacob advised clients to periodically review their investment portfolios to maintain their desired asset allocation and adjust for any significant changes in market value. Insurance and hedge options. He recommended considering insurance products such as life insurance or annuities and using derivatives to hedge against potential losses in their portfolio. Jacob's approach underlined an important truth: understanding risk is crucial to survival in the world of investing. The seeds of recovery, New Deal policies. As the nation grappled with despair, the United States government initiated a series of recovery efforts known as the New Deal. Jacob closely studied these initiatives, understanding that they provided guidance on how institutions can bolster economic recovery. Lessons from government intervention. Fiscal policy. The government's role in stimulating the economy through spending and tax cuts became evident. This highlights the importance of understanding macroeconomic policies and their impact on personal investments. Regulatory framework. The establishment of the Securities and Exchange Commission, SEC, was aimed at restoring investor confidence and protecting against fraud. Modern investors should recognize the value in regulations that help maintain market integrity. Safety nets. Programs such as Social Security emerged, reminding individuals of the importance of having a financial safety net. Modern investors should seek to create safety measures for personal well-being, including retirement savings, health insurance, and supplemental income plans. Jacob's belief in fairness and stability embodied in these policies taught him that a strong economy relies on both individual contributions and collective support. Connecting past to present. As we walk through the shadows of the Great Depression with Jacob, let's draw parallels to today's economic landscape. Modern reflections, diversification. In an era of burgeoning technology stocks, cryptocurrencies, and shifting economic policies, maintaining a well-rounded portfolio is essential. Look beyond traditional stocks. Consider REITs, real estate investment trusts, ETFs, and bonds to spread the risk. Persistence in cash reserves. Current inflation and market volatility call for an even greater emphasis on cash management. Personal finance experts recommend keeping an emergency fund that covers at least 3 to 6 months' worth of expenses. Education on risk. Investors today must take the initiative to educate themselves about market risks. Utilize online resources, finance courses, and community workshops to enhance your understanding of financial markets. Actionable advice. Here are practical steps modern investors can take, inspired by Jacob's insights. Set a dedicated emergency fund. Start with a small, manageable amount and gradually build it up to your comfort level. Invest in a diversified mix of assets. Allocate across stocks, bonds, and alternative investments to reduce risk. Educate yourself continuously. Follow finance journals, attend webinars, and participate in discussions around current events and how they can impact the markets. The legacy of the Great Depression. The Great Depression not only shaped the landscape of modern economics, but also forged a new generation of savvy investors. Jacob's lessons on diversification, cash management, and risk awareness became the foundation of his enduring legacy. As we turn our focus to the next era, the post-war boom, let's carry forth the invaluable insights gleaned from this historical moment. Summary and key takeaways. Diversification is essential to mitigate risks during market downturns. Maintaining cash reserves is crucial for weathering financial storms. Understanding risk management and establishing safety nets can elevate your financial stability. Government interventions during crises reveal valuable lessons about collective resilience and support. Continuous education and proactive financial planning are the keys to thriving in today's markets. The Great Depression teaches us that no matter how dire the crisis, it is possible to emerge stronger, wiser, and more prepared for the challenges that lie ahead. Embrace the lessons of the past as we embark on our next financial journey into the post-war economy, a time rich with opportunity and potential. Chapter 4: The Post-War Boom, an Era of Opportunity. Chapter 4: The Post-War Boom, an Era of Opportunity. In the wake of World War II, a new chapter in global history emerged, bursting with unprecedented economic growth and prosperity. This era, often dubbed the post-war boom, was characterized by innovation, consumerism, and a burgeoning middle class. In this chapter, we explore the factors that fueled this remarkable economic expansion, guided by the insights of a visionary entrepreneur who saw opportunities where others saw uncertainty. We will also examine investment strategies during this growth period and the emergence of the middle-class investor, a shift that would redefine the landscape of American finance. Historical context. The road to recovery. Aftermath of war. The devastation of World War II left many economies in ruins. However, the United States emerged as a victor with an unparalleled industrial base, massive production capabilities, and a desire to innovate. The GI Bill, implemented in 1944, played a crucial role in facilitating higher education for millions of returning soldiers and homeownership through low-interest loans. This influx of educated individuals into the workforce would become a driving force behind the economic expansion. The global economy. Simultaneously, Europe and Asia were recovering from the war, aided by the Marshall Plan, which provided substantial financial support for rebuilding efforts. By the late 1940s and early 1950s, global markets began to stabilize, creating pathways for trade. As products began flowing from factories to consumers, a newfound sense of optimism prevailed. Meet our guide, Robert Bob Emerson, visionary entrepreneur. As we step into the shoes of Robert Emerson, let us imagine him as a dynamic entrepreneur emerging from the post-war haze. A young man in his early 30s, Bob returned from military service with ambitions as grand as the horizon. Instead of settling for a standard 9-to-5 job, he envisioned a business that catered to the rising consumer class. I recognized a simple truth, Bob recalls. People wanted more than just basic necessities. They craved quality products at affordable prices. It was time to build something that aligned with that collective aspiration. The spirit of entrepreneurship. Bob embraced the spirit of entrepreneurship that flourished in the post-war era. The appetite for goods positioned him favorably to launch a line of innovative consumer products. Recognizing the burgeoning demand for household items, he dedicated his efforts to creating a relatable brand that appealed to a country eager to embrace a newfound lifestyle. Economic indicators of prosperity. As we traverse through this transformative period, several economic indicators illustrated the profound growth taking place in America. Gross domestic product, GDP. From 1945 to 1960, GDP grew at an average annual rate of about 4.5%, and by 1960, it had increased more than 250% from pre-war levels. Job creation. Employment surged, with millions of jobs created in manufacturing, services, and retail, significantly reducing the unemployment rate. Wage growth. Real wages rose, resulting in increased disposable income for families. This growth enabled households to invest in homes, cars, and consumer goods. Stock market performance. The stock market began to see consistent upward trends as companies experienced revitalized earnings, leading to more people investing. By the end of the 1950s, the Dow Jones Industrial Average rose sharply, a positive sign of investor confidence. Investment strategies in a growth economy. Bob's entrepreneurial journey was not solely about running a business. It was also about strategic investments. The post-war boom provided a fertile ground for investment opportunities. Here are some lessons drawn from Bob's journey. Invest in what you believe in. Bob understood that success stems from passion. He invested in industries he believed would thrive. His product line was not merely a collection. It was an embodiment of his beliefs in quality and functionality. Actionable advice. Identify sectors that resonate with your values and interests. Investing in industries you understand can provide better insights and confidence in making investment decisions. Embrace diversification. As businesses flourished, Bob learned the importance of diversification, not just in his products, but in his investments. By spreading his investments across multiple sectors, he mitigated potential risks. Actionable advice. Diversification reduces risks associated with market volatility. Consider including a mix of stocks, bonds, and alternative investments in your portfolio. Stay informed. Bob kept abreast of market trends and shifts in consumer preferences. His ability to pivot quickly allowed him to refine his business strategy and respond to emerging opportunities. Actionable advice. Continuously educate yourself on market trends, economic indicators, and industry news. Subscribing to financial newsletters or attending workshops can enhance your understanding. Invest in innovation. The post-war era was rich with technological advancements. Bob understood that investing in innovative products could yield significant returns. He collaborated with researchers and engineers to develop technologies that would set his products apart. Actionable advice. Consider investing in companies that prioritize research and development, R&D, or emerging technologies. Look for sectors such as renewable energy, biotech, or technology startups. Seek long-term gains over short-term speculation. Bob adopted a long-term investment mentality. He recognized that true wealth is built over time, not through quick wins. Actionable advice: focus on long-term investment strategies rather than trying to time the market. Consider index funds or blue-chip stocks that can provide stability and growth over time. The rise of the middle-class investor. The post-war boom transformation was not just about industrialists like Bob. It engendered the rise of the middle-class investor, building wealth through investment. With the economy booming, average Americans began actively participating in the stock market. The introduction of employer-sponsored retirement plans and mutual funds democratized investing, making it accessible to individuals who had never considered investing before. Employee savings plans. Companies began offering 401k plans, allowing employees to invest a portion of their salary pre-tax, fostering a savings culture among workers. Mutual funds. The creation of mutual funds allowed individuals to pool their resources for collective investment, offering diversification and professional management that individual investors often lacked. Education and awareness. Financial advisors started to emerge as trusted consultants for the everyday investor. As economic prosperity grew, financial literacy campaigns taught the importance of budgeting, saving, and investing. Key lessons for today's investors. As we draw lessons from the post-war boom, we must recognize the lasting impact of this era on modern investment strategies. Here are key takeaways for investors today. Adaptability is crucial. Like Bob, be prepared to adapt your strategies to market changes. Economic environments evolve, and remaining flexible is key. Invest for the long haul. With the return to greater market volatility, it's vital for contemporary investors to prioritize long-term growth rather than immediate gains. Embrace technology. Today's innovation-driven economy parallels the post-war period. Look at sectors influenced by technology and sustainability as potential investment avenues. Educate yourself. Safety begins with knowledge. Engage in continuous learning about finance, investment strategies, and personal finance management. Participate in the market. Consider starting small with investments through apps or robo-advisors that lower the barrier to entry, ensuring that everyone can partake in the financial growth narrative. Summary and key takeaways. The post-war boom was more than an economic phenomenon. It was a transformative period that reshaped consumers' expectations and investment strategies. Bob Emerson represents the innovative spirit of this era, one that embraced risk, recognized opportunities, and fostered the growth of the middle-class investor. As we navigate our contemporary financial journeys, let us carry forward the lessons learned during this era of opportunity. Invest in what you believe in. Diversify your portfolio. Stay informed about market trends. Embrace innovation. Focus on long-term gains. The era of the post-war boom laid the foundation for a financial landscape open to all, a legacy that continues to influence today's investors. As we prepare to delve into the next chapter, where turmoil challenges growth, remember that every economic cycle carries lessons from the past, lessons that can guide us toward a more secure financial future. Chapter 5, Inflation and the Oil Crisis, the 1970s. Chapter 5, Inflation and the Oil Crisis, the 1970s. As we step into the tumultuous decade of the 1970s, we meet our guide for this chapter, a frugal investor named Edward Merrick. A diligent saver and an astute observer of market trends, Edward lived through unprecedented economic changes, marked primarily by soaring inflation, rising oil prices, and a shifting landscape in the investment world. This chapter will leverage Edward's experiences to illuminate how investors can adapt their strategies during times of economic instability. Understanding the economic climate of the 1970s. The 1970s were characterized by a unique combination of challenges that left a profound impact on the global economy. High inflation rates. The decade began with an annual inflation rate of around 5%, which ultimately skyrocketed to over 13% by 1980. The average consumer felt the pinch as the cost of basic goods and services surged. Oil crises. Events such as the Yom Kippur War in 1973 and the Iranian Revolution in 1979 led to oil embargoes, drastically increasing fuel prices. This resulted in further inflationary pressures and significant changes in consumer behavior. Stagflation. The curious phenomenon of stagflation emerged, where inflation rose alongside stagnant economic growth and high unemployment. Traditional economic theory struggled to explain this paradox, leaving policymakers scrambling for solutions. Edward's perspective, a journey begins. As a keen observer of these shifting tides, Edward Merrick knew that he had to adapt his investment strategy to survive the economic upheaval. With rising prices and a volatile stock market, he shifted his focus from growth stocks to income-producing investments that could keep pace with inflation. The importance of diversification. One of the first and most crucial lessons Edward learned was the importance of diversification during uncertain times. He understood that placing all his assets in one type of investment could be catastrophic if that sector were to underperform. Strategies for diversification. Asset allocation. Edward spread his investments across various asset classes, including real estate. Properties began to appreciate, serving as a hedge against inflation. Stocks. He invested in dividend-paying stocks to generate income even as prices fluctuated. Bonds. Though interest rates eventually rose, Edward carefully selected long-term bonds that offered stable returns. Geographic diversification. Recognizing that markets were reacting differently to economic pressures, Edward started investing in foreign stocks and emerging markets, allowing him to capitalize on global opportunities. Alternative investments. In a bid to hedge against inflation, Edward considered commodities, particularly gold, which historically retained value during economic uncertainty. Practical example: a balanced portfolio for rising inflation. To illustrate how a diversified investment strategy would work, let's consider Edward's hypothetical portfolio in 1975. 30% real estate, rental properties generating steady cash flow. 25% dividend-paying stocks, well-established companies with a history of rising dividends, e.g. Procter & Gamble. 20% bonds, a mix of government bonds and high-yield corporate bonds. 15% commodities, direct investments in oil and gold futures. 10% emerging markets, stocks from countries experiencing rapid economic growth. Adjusting investment strategies. The key to thriving in the 1970s was agility. Edward took proactive steps to adjust his investment strategy in response to economic indicators, paying close attention to signs from policymakers and market trends. Tactics for adjusting strategies. Monitoring inflation rates, Edward kept a close watch on Consumer Price Index (CPI) reports, which informed his decisions on asset reallocation. Responding to policy changes, understanding that interest rates would rise, he began gradually shifting away from long-term bonds, favoring shorter durations to mitigate interest rate risk. Investing in inflation-protected securities. As the Treasury introduced inflation index securities, Edward embraced these tools to safeguard his investments from inflationary pressures. Thought exercise. Mindset shift. Consider how you view your investment portfolio today. Reflecting on Edward's experience, ask yourself the following questions. Are your investments diversified across various asset classes? How often do you review your investments in response to economic indicators? The role of financial education. During this intense period, Edward realized that staying informed and educating himself was critical for navigating the financial markets. He immersed himself in literature, attended seminars, and actively sought mentorship from seasoned investors. Resources for investors. Books and publications. Classic texts like The Intelligent Investor by Benjamin Graham provided timeless principles. Financial seminars. Attending workshops on inflation and financial literacy broadened his understanding. Networking. Engaging with fellow investors offered new perspectives and strategies. Facing the oil crisis, a case study. Illustratively, let's examine a pivotal moment in Edward's investment journey during the oil crisis of 1973. As oil prices surged, transportation costs increased dramatically, pushing overall prices upward. Action plan. During the oil crisis, sector rotation. Edward rotated his investments out of sectors heavily dependent on oil, such as transportation and automotive, and into defensive sectors like utilities and consumer staples that performed relatively well even during economic downturns. Investing in energy. Recognizing the shift, Edward took a calculated risk and invested in energy companies poised to benefit from rising prices like Exxon and Chevron. Behavioral adjustments. Rather than panic selling, he maintained a long-term vision, reassured by his diversified strategy. Key takeaways for modern investors. As we conclude Edward Merrick's journey through the financial landscape of the 1970s, we draw significant lessons applicable not just to his time, but to today's economy. Embrace diversification. A multifaceted investment strategy mitigates risk and adapts to economic fluctuations. Stay informed. Knowledge is a powerful tool. Staying educated through various channels enhances your decision-making prowess. Be agile. The ability to adjust your strategy based on economic indicators is vital to navigating volatile markets successfully. Explore alternatives. Explore different asset classes, including real estate and commodities, to hedge against inflation. Summary. The 1970s taught us the importance of adapting investment strategies to shifting economic landscapes. Through the eyes of Edward Merrick, we learned about diversification, vigilance, and proactive adjustment, enriching our understanding of how the past informs the present. As we prepare to transition to the next chapter, which will explore the dot-com boom, remember that history is not merely a series of events, it is rich with lessons that can guide our financial futures. With Edward's experiences in mind, let us gear up for the technological wonders of the late 1990s that promise both opportunity and upheaval. Chapter 6, The Dot-Com Boom, Riding the Digital Wave. Chapter 6, The Dot-Com Boom, Riding the Digital Wave. The world stood at the precipice of a new era in the late 1990s. The internet was no longer a mere novelty, but was evolving into a global phenomenon intersecting with commerce, communication, and culture. In this chapter, we follow the journey of an early tech investor, Alex Martin, whose experiences during the dot-com bubble illustrate the necessity of thorough research and awareness of herd mentality when investing in emerging industries. A glimpse into the digital frontier. In the summer of 1997, Alex Martin was a fresh graduate with a keen interest in technology and finance. While his peers sought traditional careers in banking or law, Alex found himself captivated by the rising tide of online startups. Fueled by visions of digital marketplaces and revolutionary platforms, he decided to invest his modest savings in a few promising tech stocks, including a small company called E-Trade. While browsing investment forums, he was drawn into discussions filled with vigorous enthusiasm and inflated optimism for the burgeoning dot-com industry. The excitement of early investments. The excitement surrounding the new economy was palatable. Stocks of tech companies soared as venture capital flowed freely, hoping to latch on to what was perceived as the future of business. E-Trade's stock price skyrocketed, and within months, Alex saw his investment multiply. Encouraged by quick gains and a growing portfolio, Alex began to read up on potential investment opportunities more obsessively and joined online groups where bullishness reached a fever pitch. The herd mentality. Following the crowd. As Alex became more involved in the online trading community, he couldn't help but notice a recurring trend among the discussions: the herd mentality. Investors rallied around popular stocks, often driven by nothing more than sentiment and speculation. Websites like pets.com and eToys became the rallying points of excitement. Despite the absence of solid financial fundamentals, stock prices surged, often driven by hype rather than performance. Red flags ignored. Alex soon found himself caught up in this frenzy. He began to ignore critical warning signs. Valuations disconnected from reality. Companies with little to no revenue had market caps worth billions. Over-exuberance. The mantra became, "This time it's different." Investors believed that tech would alter all established market rules. Lack of research. Instead of due diligence, many investors relied on others' opinions and trends highlighted in chat rooms. The turning point. Slower growth and profitability concerns. By late 1999, cracks in the facade of the dot-com boom began to emerge. Companies once heralded as the next big thing struggled to maintain profitability. When major players like Amazon and eBay failed to turn a profit, questions arose. However, those questions were often drowned out by the prevailing bullish sentiment. Alex, driven by dreams of digital riches, invested heavily in a new venture he'd heard praised online, an aggregator that promised convenience in the chaotic web space. The alarm bells of reality. Then the bubble burst. In March 2000, the Nasdaq Composite peaked at 5,048.62 before plummeting. Tech stocks, some losing up to 90% of their value, fell like dominoes. The exuberance gave way to despair, and realized losses became a horrifying reality for many investors who had bought into the excitement without caution. Alex checked his portfolio. A third of his investments had vanished in thin air. Lessons learned: market research and risk awareness. As the dust settled, Alex found himself with nothing but question marks and lessons learned the hard way. His journey through the dot-com boom emphasizes a vital lesson for today's investors. Key takeaways from Alex's experience: conduct thorough research. Understand the fundamentals of the companies you're investing in. Look for revenues, profit margins, and business models that make sense in the long run. Beware of herd mentality. While trends can offer opportunities, avoid making investment decisions based solely on what everyone else is doing. Stay informed and independent in your decision-making. Diversify your portfolio. Don't put all your eggs in one basket. When investing in emerging industries, ensure to diversify across various sectors to manage risk effectively. Establish risk tolerance. Understand how much risk you're willing to take and stick to your investment strategy, regardless of market noise. Embrace patience. Many successful investments require time and often a volatile market to grow. Avoid the temptation for quick wins. Instead, focus on long-term gains. Bridging the past and present. Investments in tech today. As we reflect on Alex's story, it becomes evident that the lessons from the dot-com boom are relevant in today's dynamic market landscape. Fast-paced industries continuously emerge, from green technologies to artificial intelligence, echoing the excitement of the late 1990s. Apply these timeless strategies today. Do your due diligence. Engage in qualitative and quantitative analyses. Look at the key performance indicators and long-term business strategies of emerging tech companies. Stay grounded amid buzz. With social media and instant news, the chatter can easily skew perceptions. Cross-reference sources before making decisions based on trends. Invest in what you understand. Focus on industries and companies that you have a grasp over. This will improve your decision-making and confidence. Market corrections can be opportunities. Instead of panicking during downturns, view them as opportunities to acquire strong stocks at lower valuations. Interactive reflection. The dot-com investors quiz. Take a moment to reflect on your investment approach with these questions. Have I thoroughly researched the last 5 investments I made? Do I follow investment trends because I believe in them, or just because others do? Are my investments diversified? What risks am I currently exposing myself to? How would I feel if my portfolio lost 30% overnight? What would my reaction be? Can I define my long-term investment strategy? Summary and key takeaways. The dot-com boom serves as a vivid reminder of how speculation can distort reality and how crucial it is to maintain a sense of grounded financial understanding amidst overwhelming excitement. Alex's story encapsulates both the highs and lows of investing in uncharted waters, reinforcing timeless principles that remain valid today. Always do your homework and understand the companies you invest in. Avoid following the crowd. Instead, reflect on your conducting research. Diversification is critical for managing risk, especially in emerging fields. Be patient and have a long-term vision for your investments. Continuously educate yourself about market dynamics and economic fundamentals. In the next chapter, we will explore the financial crisis of 2008, examining the mistakes made and the lessons learned about risk management and economic interdependence. Join us as we venture further into the financial time machine. Chapter 7. Lessons from the Financial Crisis, 2008 and Beyond. Chapter 7. Lessons from the Financial Crisis, 2008 and Beyond. In the world of finance, few events have left as deep a scar as the 2008 financial crisis. With its roots cleverly buried in complex financial instruments, excessive risk-taking, and a widespread culture of greed, this crisis shook the very foundations of our global financial systems. For many, it was an awakening, a reality check about the fragility of perceived wealth and the critical importance of sound investment principles. In this chapter, we will journey through the events of the crisis, guided by the insightful thoughts of a contemporary investor who faced the storm head-on. As we progress, we will unearth essential lessons on credit risk, liquidity, and preparedness, giving you the tools to navigate any future uncertainties. The prelude: a perfect storm. To understand the magnitude of the 2008 financial crisis, it's vital to consider how we arrived at that brink. The early 2000s were characterized by a sense of invincibility in the financial markets, much like the excitement surrounding the tech boom years earlier. With low interest rates and a booming housing market, opportunists flocked to invest in real estate. Mortgage lenders, in their unbridled enthusiasm, began creating complex mortgage-backed securities, MBS, consisting of high-risk subprime loans, loans given to borrowers with poor credit histories. As these MBS were repackaged and sold across the globe, the world became entangled in an intricate web of high-stakes investments. Investors believed they held solid assets when, in reality, they held ticking time bombs. Let's follow the journey of Emma Caldwell, a fictional composite character representing many individuals who navigated through these turbulent times. Meet Emma, the reluctant investor. Emma Caldwell was a young finance professional working in New York City before the crisis. She had watched friends and family accumulate wealth through real estate and stock investments, believing she too could join their ranks. Emma approached investing cautiously, initially relying on a well-regarded financial advisor. In 2007, she made her first major investment in a REIT, real estate investment trust, that focused largely on residential properties bundled into mortgage securities. The inflection point. As 2008 dawned, things quickly shifted. News of foreclosures began to flood the media, and real estate values plummeted. Emma's REIT investment started to wobble, and her financial advisor assured her it was merely a bump in the market. But as she attended industry seminars and listened to fellow investors' experiences, she became deeply concerned about exposure to credit risk, an unseen beast lurking beneath the surface. Key lesson number 1: understanding credit risk. Credit risk basics. At its core, credit risk involves the potential that a borrower will default on their obligation, making related financial instruments, like bonds or MBS, worthless. The 2008 example. During the crisis, the undeniable truth emerged. Many of the loans within those securities were held by borrowers who had no means to repay them. MBS turned toxic, taking billions of dollars with them. Actionable tip. Before investing in any asset, conduct a thorough assessment regarding the quality of the underlying credits. Review the credit ratings of securities. Confirm the borrower's credentials and history. Investigate economic factors affecting the borrower's ability to repay. The dreadful fall. As panic spread throughout financial institutions, Emma watched as her investment portfolio began to crumble. Banks, reeling from colossal losses from bad loans, began tightening their credit standards, leading to a full-blown liquidity crisis. The privilege of access to cash diminished overnight amidst frantic sell-offs and plummeting asset values. Key lesson number 2: the importance of liquidity. Liquidity basics. Liquidity refers to how easily assets can be converted to cash without significantly impacting their price. The 2008 example. During the crisis, many investors found themselves unable to sell their illiquid investments at fair prices. With cash reserves dwindling and credit drying up, countless individuals faced financial ruin. Actionable tip: ensure a solid liquidity strategy. Maintain a diversified portfolio that includes liquid assets such as cash or short-term bonds. Establish an emergency fund covering at least 3 to 6 months of living expenses. Regularly review your investment's liquidity, understanding which can be easily liquidated, a hard reality. By the time the dust settled in early 2009, numerous major financial institutions had collapsed or been absorbed by larger entities, while millions lost their homes, jobs, and confidence in the financial markets. Emma, determined not to repeat her mistakes, began a thorough review of her investment approach, taking on the mindset of a long-term thinker instead of a hopeful speculator. Key lesson number 3: prepare for the unexpected. Investment psychology can be deceiving. It often leads individuals to believe that historical performance will persist. Emma realized the need to build resilience against unexpected market drops. Historical market volatility. While the market experiences periods of growth, it will inevitably face downturns. This is just part of its rhythm. The 2008 example. Advocates of risk management will point out how the short-sighted nature of investors led to widespread devastation during the 2008 crisis. Actionable tip: prepare yourself for the unexpected by developing a comprehensive investment plan that includes risk diversification, conducting regular audits of your financial situation and adjusting your asset allocation based on current market conditions, implementing stop-loss orders or hedging strategies to create safeguards. Emma's future, the investor rebuilt. Over the ensuing years, Emma transformed her investment strategy by drawing valuable insights from her experiences during the crisis. She adopted a long-term value investing philosophy, researching her investments meticulously instead of succumb to trends. She sought mentorship and joined investment clubs, gaining perspective and discipline. Contemporary tools, ways to invest smart. In addition to traditional knowledge, today's investors can utilize modern tools for informed investing. Here are some contemporary strategies inspired by historical lessons. Use technology. Investment apps and robo-advisors can help manage portfolios effectively while providing critical insights and data. Diversification by classes. Explore diverse asset classes beyond stocks and REITs, such as commodities, cryptocurrencies, and peer-to-peer lending. Stay informed. Subscribe to financial journals, podcasts, and financial news to remain educated about shifts in economic indicators and market behaviors. Key takeaways. The lessons from the 2008 financial crisis carry crucial wisdom for today's investors. Understand credit risk. Prioritize due diligence on any investment, particularly those tied to credit. Maintain liquidity. Ensure a balanced portfolio that protects against illiquidity during turbulent times. Prepare for the unexpected. Acknowledge that market downturns are part of investing. Expect them and plan accordingly. Emma's journey serves as a powerful reminder of the lessons learned in times of uncertainty. By leveraging the knowledge of past mistakes, you too can navigate your financial landscape with confidence and resilience. In the next chapter, we will turn our focus to emerging markets and explore the opportunities they present in a global economy. Just as the mistakes of the past can sharpen our strategies today, the emerging markets might hold the keys to future growth and innovation. Chapter 8. Emerging Markets, Opportunities in a Global Economy. Chapter 8. Emerging Markets, Opportunities in a Global Economy. Introduction. The Global Investor. Imagine standing on the bustling streets of Mumbai or surveying the skyline of São Paulo. These cities symbolize not only the rapid economic growth of emerging markets, but also the vast opportunities that investors can seize. To guide us, we meet our narrator, Amira Patel, a seasoned investor who has traversed the world, unlocking the secrets of emerging economies and their potential for modern investors. Amira's journey started in her home country of India, where she took her first steps into the world of finance. Over the years, she has cultivated a profound understanding of the intricacies of emerging markets. Recognizing the powerful waves of change that can propel a nation and your investment portfolio forward. Understanding emerging markets. What are emerging markets? Emerging markets are nations with economies that are in a state of transition, marked by rapid growth, industrialization, and urbanization. They typically possess the following characteristics. Economic development. Emerging markets are in various phases of growth, often experiencing significant increases in gross domestic product, GDP. Market accessibility. While access to these markets may initially be limited, there is an increasing trend toward globalization, allowing more opportunities for foreign investors. Investment risks. These markets may exhibit higher volatility compared to developed markets, often influenced by political instability, currency fluctuations, and evolving regulatory environments. Prominent examples of emerging markets include Brazil, China, India, South Africa, Vietnam. Historical context. Lessons from the past. Amira aptly notes that lessons from historical financial events in these regions provide insight into the potential and pitfalls of investing in emerging markets. Brazil and the 1980s debt crisis. The 1980s saw Brazil struggle with overwhelming debt, resulting in hyperinflation and economic malaise. This period taught valuable lessons on the importance of sovereign stability. Investors should assess the political and economic stability of a nation before committing capital. Understanding economic indicators. Learning to interpret inflation rates, GDP growth, and currency stability is essential in gauging market health. Historical lessons to modern applications. As the world continues to globalize, the lessons learned from past events in emerging markets can be directly applied to current investment strategies. Here are some takeaways. Diversification, incorporating a balanced mix of investments across different regions, can mitigate risks associated with individual countries. Long-term perspective. Emerging markets often take years to realize their full economic potential. Investors need to cultivate patience, understanding that short-term volatility is part of the journey. The current landscape of emerging markets, growth potential, and opportunity. According to the International Monetary Fund, IMF, emerging markets are responsible for a considerable share of global economic growth. In many cases, their economies are expanding faster than those of developed nations. Key sectors currently driving the growth of emerging markets include technology. Nations like India and Kenya have seen a surge in fintech, mobile banking, and tech startups. Consumer goods. A rising middle class in nations such as China and Brazil is creating demand for various consumer products and services. Infrastructure. Significant investment in infrastructure development opens avenues for construction, real estate, and technological advancements. Investing strategies for emerging markets. Amira shares her investment strategies for tapping into these growth opportunities. Use of ETFs and mutual funds. Exchange-traded funds, ETFs. Invest in ETFs that focus on emerging markets to gain exposure while minimizing risk through diversification. Mutual funds. Consider mutual funds managed by seasoned professionals familiar with local markets. Focus on growth narratives. Identify sectors experiencing rapid expansion within emerging markets, e.g., renewable energy, tech. Investing in local ventures. Research local startups and businesses that are expanding but may not yet have attracted large investment from global firms. Staying informed on global trends. Understand how global economic events impact emerging markets. For instance, rising interest rates in the U.S. can lead to capital outflows from these economies, affecting their currencies and markets. Risks and challenges. Despite the exciting prospects, investing in emerging markets comes with unique risks. Political uncertainty. Transitioning governments may impose regulations that affect business operations. Currency risk. Fluctuations in currency values can lead to significant gains or losses for foreign investors. Market volatility. Emerging markets often see larger swings in investment returns compared to developed markets. To mitigate these risks, Amira advises adopting a proactive approach. Conduct thorough research. Understand regional dynamics, economic indicators, and local news cycles. Engage local knowledge. Collaborate with local investment advisors or firms with expertise in the desired countries. Case studies. Successful investors in emerging markets. To illustrate her points, Amira reflects on the success stories of contemporary investors who utilize the lessons from history to navigate these waters skillfully. Case Study 1. The Rise of a Chinese Tech Giant. Meet Li Wei, an early investor in a now prominent Chinese tech company. Recognizing the potential of the burgeoning technology sector in China, he made a calculated investment during the early days of the internet boom in the country. Drawing on lessons from past tech bubbles, he diversified his investments and stayed informed about regulatory changes, leading to substantial long-term returns. Case Study 2. The Agribusiness Pioneer. Sarah Thompson, an American entrepreneur, saw potential in Africa's agriculture sector. She sought out partnerships with local farmers and invested in sustainable practices that significantly drove up productivity. Understanding from Brazil's agricultural growth in the early 2000s, she focused on building resilience in her operations, preparing for potential global market fluctuations. Interactive component. Before we conclude this chapter, here's a thought exercise for you. Quiz: what would you do? You have $10,000 to invest in an emerging market. You identify Brazil, but recent political news reports instability. A. Invest immediately, trusting in long-term economic growth. B. Hold off until the political environment stabilizes. C. Invest in an emerging market ETF that includes Brazil, but also diversifies into other regions. A friend suggests investing heavily in a single tech startup in Vietnam. You recall the risks associated with concentration. A. Convince them to diversify into several different tech businesses. Agree with them. After all, tech is booming. C. Conduct research to understand the market potential of that startup before deciding. Conclusion: applying lessons of the past. In closing, Amira emphasizes that investing in emerging markets is not for the faint of heart, yet the historical lessons remind us that opportunities abound. As she waves goodbye, she leaves readers with this wisdom: stay educated. Always seek knowledge about the regions where you invest. Be prepared for volatility. Accept that the path may be bumpy, but patience pays off. Diversify your risks. Look out for opportunities across various sectors and countries to protect against downturns. By applying the lessons of history to today's emerging markets, you harness the potential to thrive in the global economy, making the leap from a passive observer to an active participant. Key takeaways: emerging markets offer immense growth opportunities driven by technology, consumer demand, and infrastructure development. Investors should leverage historical lessons regarding economic stability, sector focus, and diversification. Recognize and manage the unique risks associated with investments in emerging markets. The journey of investing requires informed decision-making, patience, and a commitment to understanding global trends. With this knowledge in hand, readers can begin their adventure into the landscape of emerging markets, driven by the past but focused on a promising financial future. Chapter 9: The Rise of Cryptocurrencies, a Modern Speculative Frontier. Chapter 10: Sustainability and Ethical Investing, the New Wave. Chapter 10: Sustainability and Ethical Investing, the New Wave. Introduction: A New Paradigm. In recent years, a seismic shift has occurred in the investment landscape, one that prioritizes ethical considerations and sustainability alongside traditional financial metrics. This chapter embarks on a journey with Emma Green, a socially conscious investor navigating the complex waters of sustainable markets. Emma is not just an investor. She is a passionate advocate for aligning her investments with her values. Through her story, we will explore the importance of ethical investing and how it represents a significant trend in contemporary financial behavior. Meet Emma Green, the ethical investor. Emma grew up in a family that valued both environmental sustainability and social justice. As a child, she often accompanied her parents to local farmers markets, learning about organic farming and the importance of supporting local businesses. These experiences laid the groundwork for her beliefs about consumer choices and their impact on the world. In her early 20s, Emma became increasingly aware of how traditional investing practices often supported industries that contradicted her values, such as fossil fuels, tobacco, and companies with poor human rights records. As a result, she made a conscious decision to shift her investment focus towards sustainability and ethical practices. The rise of sustainable investing. The trend towards sustainable investing is not merely a passing fad. It's a powerful movement reshaping the financial landscape. Here's how. Market growth. The global sustainable investment market reached over $35 trillion in 2020, signifying a huge shift in investor sentiment. This figure has only continued to grow as awareness builds around the climate crisis and social injustices. Impact on performance. Research indicates that sustainable investments often outperform traditional ones. Companies that are committed to sustainability tend to mitigate risks and have better long-term viability. Understanding sustainable investing. Sustainable investing encompasses a broad range of principles and strategies, including environmental, social, and governance (ESG) criteria. This framework evaluates companies based on their environmental impact, social responsibility, and governance practices. Investors look at factors such as carbon emissions, labor practices, and diversity in leadership. Socially responsible investing, SRI. SRI involves choosing investments that align with one's ethical values, often by excluding certain sectors known for negative social impact, such as alcohol, gambling, or arms manufacturing. Impact investing. This form of investing aims to generate measurable social or environmental impacts alongside financial returns. Investments are directed toward projects and companies that are explicitly working on solutions to social issues. Historical context. The roots of ethical investing. To understand the current wave of sustainability and ethical investing, we must consider its historical roots. In the 1960s and 70s, socially conscious investing began to gain traction during significant social movements, including the civil rights movement and the anti-Vietnam War protests. Divestment movements. Protesters began to call for the divestment of funds from companies involved in the Vietnam War and South African apartheid. These early movements demonstrated the potential for individuals to influence corporate behavior through investment choices. Introduction of ESG criteria. In the late 20th century, investors began to formulate definitive criteria for what constituted ethical investing. The term ESG emerged to encapsulate these ideas, providing a structured approach to incorporating ethics into investment decisions. Connecting past to present. As Emma reflects on her journey, she draws parallels between the early divestment movements and today's ethical investing practices. Many investors, particularly younger ones, increasingly seek to align their portfolios with their values. They understand that the investment decisions they make can support broader societal change. The case of fossil fuels. A cautionary tale. Emma often recalls the example of fossil fuel divestment as a remarkable case study in ethical investing. Major institutions, including universities and pension funds, have begun to divest from fossil fuel companies. This trend highlights the growing awareness of climate change and the recognition that certain industries pose long-term risks. The 2015 Paris Agreement. As global leaders gathered to address climate change, the momentum for fossil fuel divestment surged. Emma recognizes that impacts from climate change will create unprecedented social and economic upheaval, making investments in fossil fuels not only ethically problematic but also financially precarious. Practical considerations for ethical investors. Define your values. Before navigating the ethical investment landscape, it's essential to identify your values. Personal values. Assessment. Ask yourself, what social issues are most important to me? Which sectors do I want to avoid? What types of companies align with my beliefs? Research and select investments. Once you've defined your values, conduct thorough research on potential investments. Utilize online resources. Platforms like MSCI, Sustainalytics, and Morningstar provide ESG ratings that help you evaluate companies' sustainability practices. Consider ETFs and mutual funds. Many funds specialize in socially responsible investing, allowing you to diversify your portfolio while adhering to your ethical guidelines. Engage with shareholder advocacy. Some socially responsible investors actively engage with companies on ethical issues, advocating for better practices in areas such as labor rights or environmental impact. Monitor impact and performance. As an ethical investor, it's essential to track both the performance of your investments and their impact. Use impact metrics. Evaluate your portfolio's performance using metrics that measure social and environmental impacts alongside financial returns. Stay informed. Subscribe to newsletters or follow thought leaders in the ethical investing space to remain aware of shifting trends and opportunities. Case studies of modern investors. In observing contemporary investors who successfully embrace ethical investing, we can glean valuable insights. The Vanguard Group, leading by example. Vanguard has recognized the growing demand for socially responsible investing and launched several sustainable funds. Their approach to ESG investing balances performance with the desire for ethical choices, showcasing a successful model of combining values with financial returns. Asset managers like BlackRock. Under the leadership of CEO Larry Fink, BlackRock has emphasized the importance of sustainability in investment decisions. Fink's annual letter to CEOs calls for companies to reflect on how their business models fit into a more sustainable future. BlackRock's approach demonstrates an industry-wide shift towards integrating sustainability into core investment strategies. The future of investing. A call to action. Emma frequently participates in community discussions about sustainable investing, encouraging others to explore how their investment choices can reflect their values. Engaging with like-minded investors can foster a sense of community and shared purpose. Taking action. If you're contemplating making the shift toward ethical or sustainable investing, consider the following steps. Educate yourself. Take courses or read books on sustainable investing to deepen your understanding. Join online communities. Engage with forums or social media groups focused on ethical investing. Start small. Consider allocating a portion of your portfolio to sustainable funds and monitor your satisfaction with performance and impact. Summary. Key takeaways. Sustainable and ethical investing is more than a trend. It reflects a growing awareness of the impact of investments on society and the environment. Investors today have access to a plethora of resources that allow for informed decisions that align with their values. Historical movements towards divestment and the introduction of ESG criteria offer valuable lessons for contemporary investors as they navigate the ethical investing landscape. By defining your values, researching investments, and monitoring both impact and performance, you can effectively contribute to a sustainable future while pursuing financial growth. In embracing this journey, you, like Emma Green, can harness the power of your investments to create lasting change. As we move into a world that increasingly demands corporate responsibility, you have the opportunity to be at the forefront of this transformation, turning your financial aspirations into a catalyst for positive social and environmental impact. Chapter 11: Investing in a Digital World, the Role of Technology. Chapter 11: Investing in a Digital World, the Role of Technology. In the modern era, awareness of how technology interacts with investing can not only heighten our understanding of the markets, but transform our approach to personal finance. From algorithmic trading to robo-advisors, technology is the unseen hand shaping investment landscapes. As we dive into the digital world of investing, we'll explore how tools and platforms can empower you to make smarter financial decisions, and how modern investors are leveraging technology to their advantage. The digital transformation of investing. The shift from traditional investing practices to digital methods didn't happen overnight. Over the past few decades, the proliferation of the internet and advancements in computing technology have radically altered the way we invest. The evolution of financial tools, online brokerage accounts. The introduction of online platforms like E-Trade and Charles Schwab has democratized access to the stock market. No longer bound to the trading floor, everyday individuals can buy and sell stocks at the click of a button. Mobile applications. With the advent of apps like Robinhood, investors can manage their portfolios from their smartphones, providing user-friendly interfaces that make investing accessible to millennials and Gen Z investors. Robo-advisors. Services like Betterment and Wealthfront represent a new class of automated investment platforms. Utilizing algorithms, robo-advisors tailor investment strategies to individual risk tolerances and goals, allowing users to invest with ease while bypassing the need for human financial advisors. Market data tools. Platforms such as Morningstar and Bloomberg provide in-depth analyses and data metrics on stocks, indices, and commodities, allowing investors to conduct thorough research without heavy investment in professional tools. Embracing innovation. What can technology do for you? Today's investors have unprecedented resources at their disposal. However, understanding how to leverage these tools is key to enhancing your investment strategy. Key technologies in investing. Algorithmic trading. Algorithms can analyze vast data sets and execute transactions at breathtaking speeds. While this technology is primarily utilized by institutional investors, it offers retail investors insights into market behaviors. Artificial intelligence, AI. AI can scan news articles and sentiments on social media to predict stock movements and assess market trends. Blockchain. Beyond cryptocurrency, blockchain technology can assure secure transaction processes in trading and is being considered for shareholder voting. Big data analytics. Investors can analyze patterns and relationship trends within market data, providing a competitive edge. Case study: the Robinhood revolution. One of the most noteworthy developments in the investing world has been the rise of commission-free trading platforms. Robinhood has upended traditional brokerage models, attracting millions of users, especially younger investors. Let's unpack the implications. Lessons from Robinhood. Accessibility. By removing trade commissions, Robinhood encouraged a new wave of retail investors to enter the market, demonstrating that investing is not just for the affluent. Educational resources. Robinhood offers educational content to help users understand investment concepts, a critical resource given the complexity of financial markets. Community engagement. The platform includes social features, allowing users to share trades and insights, which can facilitate peer learning. Cautionary tales. As thrilling as this empowered investing environment is, it's also important to note the potential pitfalls. A surge in inexperienced investors has raised concerns about market volatility and herd behavior, where users follow trends without proper analysis. Practical steps to embrace technology in your strategy. Adopting technology in your investment approach doesn't have to be daunting. Here are actionable steps to harness the tools available. Select a user-friendly investment platform. Research and use platforms that suit your investing style, whether that's active trading or passive wealth accumulation. Look for features like educational resources, easy-to-navigate interfaces, and integrated tools for portfolio tracking. Utilize robo-advisors for passive investment. Begin with a robo-advisor that aligns with your financial goals. Most platforms will ask a series of questions to tailor a portfolio to your risk appetite. Regular updates provided by these platforms can help you stay informed without needing to become a financial expert. Stay informed with big data analysis. Consider obtaining subscriptions to data analysis tools to explore trends and patterns. Many of these resources offer trial periods, allowing you to understand their value before committing. Follow influencers and analysts on social media who provide insights and forecasts. However, ensure to critically assess the credibility of the sources. Diversify with evolutionary technology. Invest in innovative sectors such as AI, clean energy, and blockchain technology, which are becoming vital as the economic landscape shifts. Research ETFs focused on these themes, providing exposure without needing to pick individual stocks. Continuous learning and adaptation. Stay updated on technological advancements and market trends through blogs, podcasts, and webinars. The financial landscape continually evolves, and staying informed enables strategic adjustments to your investment approach. Reflection on the historical lens. As we view today's investing landscape, it's vital to remember that technology is simply a tool. It requires a thoughtful approach. Historical lessons remind us that, regardless of the advancements available, the foundational principles of investing remain critical. Understand your risk tolerance. Just as investors navigated speculative bubbles and other financial crises, recognize that innovative technology should complement rather than dictate your strategy. Diversify your portfolio. History shows the importance of diversification in managing risk. Utilize digital tools to broaden your investment horizons. Conduct due diligence. Whether using sophisticated algorithms or mobile apps, foundational research remains essential. Don't forget to verify information against multiple sources. Looking ahead, the converging future of investing. The role of technology in investing will continue to evolve, shaping the approach of future generations. Innovations such as quantum computing may soon reach the market, drastically altering efficiencies and complexities in financial analysis. As you step into this new digital investment arena, remember that adaptation is key. Embracing change while relying on age-old principles can set you up for success in your financial journey. Summary and key takeaways. In the digital age, technology has fundamentally transformed the landscape of investing. Here are the key ideas to remember. Technology's role. Digital tools have made investing more accessible and user-friendly, allowing you to invest from anywhere. Empowerment through innovation. Robo-advisors, AI, and big data analytics can provide insights and streamlined processes, empowering you to make informed investment decisions. Cautionary approach. Stay vigilant against market behaviors influenced by novel tools, and be wary of making investment decisions based only on trends. Actionable steps. Choose the right platform, utilize all available resources, and continuously update your knowledge to remain competitive in a rapidly changing environment. By grounding your investment strategies in technology while drawing lessons from history, you can navigate today's markets with confidence and foresight. Chapter 12. The Future of Investing, Your Financial Compass. Chapter 12. The Future of Investing, Your Financial Compass. As we step into the uncharted territory of financial markets and personal finance, it's time to distill the lessons learned from our historical journey. The past has gifted us invaluable insights into human behavior, market dynamics, and economic resilience. In this chapter, we will focus on developing a forward-thinking financial strategy, employing the historical lessons we've gathered, and endeavoring to build a financial compass that guides your investment decisions in the future. The Lessons of History, a framework for modern investing. Before we dive into crafting your financial compass, let's revisit some of the critical lessons we've encountered throughout our journey. Market psychology and bubbles. From the Tulip Mania to the dot-com bubble, human emotions, greed, fear, and the herd mentality have repeatedly influenced market behaviors. Understanding this can help mitigate impulsive decisions. Diversification. The Great Depression taught us the importance of spreading risk across various asset classes and sectors. By diversifying your investments, you can better protect your portfolio against downturns. Long-term perspective. Historical events highlight the volatility of markets in the short term. Patience and a long-term investment horizon often outperform frantic, reactive trading. Due diligence and research. The rise and fall of countless companies remind us that knowledge is power. Conducting thorough research and due diligence lays the groundwork for sound investment decisions. Adaptation to change. The evolution of industries urges investors to remain adaptable and aware of emerging trends and technologies. Embracing change can lead to lucrative opportunities. This framework forms the basis of our financial compass. As we explore how to apply these lessons, we'll also develop personal financial goals and strategies that resonate with your unique situation. Defining your financial goals. A successful investor knows the importance of having clearly defined financial goals. Goals provide motivation and a measurable benchmark for success. Here's how to outline your objectives. Step 1. Self-assessment. Evaluate your current financial situation. Calculate your net worth, assets minus liabilities. Assess your income, expenses, and savings habits. Identify your risk tolerance. Are you conservative, moderate, or aggressive in your investment approach? Use questionnaires or consult with a financial advisor to gauge your risk tolerance. Step 2. Set SMART goals. Employ these SMART criteria to structure your goals. Specific. Clearly define the goal, e.g., save $50,000 for a home down payment. Measurable. Ensure you can measure progress and success, e.g., contributing $1,000 monthly. Achievable. Be realistic in what you can attain based on your financial situation. Relevant. Align your goals with your broader financial priorities. Time-bound. Set a deadline for achieving your goal, e.g., 5 years. Examples of financial goals. Short-term goals, 1 to 3 years. Build an emergency fund, 3 to 6 months of expenses. Pay off high-interest debt. Mid-term goals, 3 to 7 years. Save for a significant purchase, e.g., a car or vacation. Fund a child's education. Long-term goals, 7+ years. Invest for retirement, e.g., aiming for a nest egg of 1 million. Accumulate wealth to leave a legacy. Building your investment strategy. With your goals defined, it's time to craft a personalized investment strategy that embodies historical lessons. Here's how to structure it. Step 1. Asset allocation. Decide how to distribute your investments across different asset classes. The distribution should align with your goals, risk tolerance, and time horizon. General guidelines for asset allocation. Conservative, risk-averse, 70% bonds, 20% stocks, 10% cash. Focus on income generation and capital preservation. Moderate, 50% stocks, 40% bonds, 10% cash. Ideal for balanced growth and risk management. Aggressive, 80% stocks, 15% bonds, 5% cash. Targets maximum growth potential with higher risk. Step 2. Diversification. Employ a diversified investment approach. This mitigates risk and improves potential returns. Diversify by asset class. Incorporate stocks, bonds, real estate, commodities, and cash. Sector diversification. Invest across different industries, technology, healthcare, finance, etc. Geographical diversification. Consider international markets to tap into global growth. Step 3. Regular review and rebalancing. The importance of periodic reviews and rebalancing can't be overstated. Changing markets, financial circumstances, and goals necessitate adjustments. Schedule regular reviews. Quarterly or biannually reassess your portfolio. Rebalance as needed. Adjust your asset allocation to align with your targets and risk profile. Step 4. Embrace technology. As covered in the previous chapter, technology plays a crucial role in modern investing. Utilize digital tools and platforms for more informed decision-making. Robo-advisors, automated platforms that create and manage investment portfolios tailored to your risk tolerance. Financial apps, tools for tracking expenses, investments, and budgeting. Research platforms, access to in-depth analysis and current market data. Staying informed and adapting investing is not a set it and forget it endeavor. Staying informed about market trends and economic changes is vital to long term success. Resources for continuous learning. Market news outlets. Follow reputable financial news sources, e.g., Bloomberg, CNBC. Podcasts and webinars. Engage with thought leaders through educational content on investing. Books and blogs. Read about investment strategies, personal finance, and historical case studies. Finding your community. Engaging with a community of investors can provide support and diverse viewpoints. Consider joining investment clubs, collaborative learning through shared experiences, online forums, platforms like Reddit, and investing-focused sites for discussions and resources. Social responsibility and ethical investing. One emerging trend is socially responsible and ethical investing. Consider defining your values and aligning your portfolio accordingly. By doing so, you contribute to a better world while pursuing financial gains. Steps to ethical investing. Identify personal values. Determine which causes matter to you, e.g., environmental sustainability, social justice. Research ESG funds. Explore funds that focus on environmental, social, and governance criteria. Key takeaways. Your financial compass. As we conclude our financial expedition, remember that investing is a journey rather than a destination. Develop your financial compass using the historical lessons we've learned and set clear goals to navigate the ever-changing landscape of personal finance. Here's a quick recap. Define your financial goals. Employ the SMART criteria to set specific, measurable, achievable, relevant, and time-bound objectives. Create a personalized investment strategy. Determine your asset allocation based on your goals and risk tolerance, and ensure diversification across different classes and sectors. Embrace technology. Utilize digital tools to manage investments, conduct research, and stay informed about market trends. Stay informed and engage. Continuously educate yourself about investing and seek out a community of peers for support and knowledge sharing. Consider ethical investing. Align your investments with your personal values and the causes you care about. As you chart your course for the future, hold the lessons of history in your heart. They will guide you through the turbulent waters of financial markets, helping you reach your destination, financial independence and security, steered by a compass firmly anchored in the insights of the past. Now, go forth, future investor, and make your mark on the world of investing.